Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Markets across the Asia Pacific are reacting today to the Fed cutting its policy rate by 25 basis points. Now, to be fair, that move was widely expected. At the same time, Fed officials maintain their outlook for just one rate cut in the new year. Here's Fed Chair Jerome Powell.
With today's decision, we have lowered our policy rate 0.75 of a percentage point over our last three meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through.
The Fed also subtly altered the wording of its statement to suggest greater uncertainty about when it may cut rates again. For a closer look now, I'm joined by Jeff Grills. Jeff is head of U.S. cross markets and emerging markets debt at Aegon Asset Management. Jeff, thank you so much for making time to chat. Let's begin with the Fed decision. Not a big surprise here, but what's curious is that the Fed seems to be maybe moving more toward a neutral place. How do you read what we had from policymakers today?
Well, I think you had two official dissents where you had two governors putting no cut as we read it. And then you have Mirren who wanted a 50 basis point cut. But then you had what was considered these silent dissents, right? So 6 of the forecasts said that the Fed funds rate would stay somewhere between 3.75 and 4%. So I think what you've really set up for is a more difficult environment in 2026, especially when Powell is no longer on the committee. You're going to have a candidate that likely is announced sometime in the new year by Trump, who is going to be wanting cuts, but he's got to manage a committee that seems right now like they are nervous about too many cuts, and as they don't really think the GDP growth numbers are all that weak. The labor market's going to be the ultimate determiner in this, right? So those will be the key statistics to watch for the next couple of weeks and months. Well,
if there is a question, it seems to be around the persistence of inflation, how stubborn it is. What's your view?
Well, I mean, I think that the inflation that we've had has been somewhat tariff driven. I think I've said this before. We talked about it before. I mean, tariffs to me are a one-off inflationary impact, right? The tariff goes on, it creates a move up, and then it's not a compounding, or it doesn't do that in the future. So we are of the view that inflation should stay low enough for the Fed to continue cutting. Our official call is that they'll cut 2 times in 2026, or even the official House call is for another cut in January, although I think the next 3 labor market data points, right? We're going to get the October and November payrolls here soon, and then the December payrolls in January. But I think that what we're setting up for is if labor continues to be weak and inflation stays in sort of that 2.5% to 3%, I think their official forecasted rate is 2.5%. I don't see why we wouldn't have some more easing into 2026.
So the Fed, if it did deliver a surprise, it was on the resumption of purchases of Treasury bills. The aim, ostensibly, is to support liquidity in the overnight funding markets. From your point of view, I mean, you're looking at bond market liquidity all the time. Was this warranted?
Well, there was a lot of illiquidity in the markets back in September and early October. And part of that was a function of the government shutdown and just people wanting to be cautious. I think the Fed had forecasted that they were going to do something on the ease of either stopping purchases or doing something to aid liquidity. So a little surprising, but not really surprising. But I think the market took it positively, right? Having $40 billion, having liquidity in the markets is good. That's why you had the stocks up, anywhere from 0.5% to 1%, depending on which indicator you're looking at. And I think the Fed is always there to make sure that liquidity is functioning, right? So that's the only part that surprises me a little bit is I don't feel like it had gotten better since September. So I'm surprised they announced it as a more official program. But at the end of the day, there's plenty of liquidity in the markets. You just want to make sure that the grease is there to keep the wheels moving in the interim.
So not surprisingly, we had yields down across the curve today. More so at the short end. And right now in the Tokyo session, I think the 2 years down another basis point or so. We're trading around 352. With those lower yields, it's not a surprise to see some dollar weakness. I think in New York trading, the Bloomberg Dollar Spot Index fell to the lowest level in October. So if you've got this dollar weakness, which seems to be kind of the base case going forward here, what does it do to your philosophy on EM debt?
Well, first of all, I think that, our view has been that EM local will continue to be reasonably well positioned. It's done very well in 2025. The dollar, the dollar strength story, I think, officially turned back earlier this summer. And you have the Fed as the last central bank really easing rates. Everybody else is either on hold or has done all their cuts, or in some cases are hiking rates, as we're seeing in other major central banks. So it's not surprising to see that the dollar is weakening somewhat. I mean, as it relates to emerging markets, I mean, stronger local currencies tend to be better for them. They helps reduce their indebtedness, at least as if they have offshore indebtedness. But at the grand scheme, it's going to be really about where rates are. And as long as rates on the 10-year stay 4% or lower, right? We're at 4.13, I think, right now. That's going to be the key for these countries. They need to issue at rates that are attractive to them, and then they need to have growth. So I think it's going to be less about the currency and more about just where is their access to financing.
We've got the BOJ meeting next week. It seems right now that the market is pricing in something greater than a 90% probability of a 25 basis point rate hike, which would take this policy rate to around 75 basis points. I think that would be the highest for Japan in around 30 years. How do you view the situation with the BOJ and the implications for the broader global bond market story?
Yeah, I mean, I think it's very interesting, right? I mean, to your point, I mean, we haven't seen positive rates, much less rates where they are here in quite some time in Japan. But it's a good thing, right? I mean, I think as long as Japan doesn't choke off inflation in their economy and they can continue to get some sort of inflationary stimulus. I mean, the biggest problem they had for the last 30 years really has been disinflation. But I mean, overall, I think what's going on in Japan is sort of unique to Japan. I think in general, you're going to continue to see currency appreciation in Asian currencies, right? Renminbi probably will continue to appreciate. Some of the other regional currencies, Malaysia, Korea, things of that nature. But it's all a reflection of just a longer term trend in the US dollar. I think that the markets, US was the primary spot for people to invest. And I think people will make allocations that move away from the dollar, and that's part of that pressure you're seeing. So I think that the BOJ action is going to be a little independent, but it adds to that fuel, right? It adds to dollar weakness and going into other currencies.
So when you look at the EM debt space broadly, are you tempted to avoid the sovereign space maybe and take a flyer on corporate debt in EM?
Yeah, well, I wouldn't say we take flyers. So we've liked corporates for quite some time. I mean, corporates were the big thematic allocation coming out of COVID. The big problem you have for all of it is that, and credit markets in general, are that credit spreads are at multi-decade lows. So when you look at sovereign spreads, investment grade sovereign spreads are right around 95 to 100 basis points over. Investment grade corporate spreads in EM are as well about 100 basis points over. So you have to be very selective with what you like. We do still like some sovereigns. We think things on the gold side, we do think there are exporters like Ghana and Ivory Coast, which will continue to benefit from gold exports, as long with South Africa. We do think the local markets look attractive. So our favorite is Mexican 10-year rates. And on the corporate side, I would probably go more towards the metal and mining as ones that will likely benefit. But there are a number of select corporates. The corporate market is huge now, which is nice. So there are a lot of corporates that you can pick from. But it's going to be an interesting year just because spreads are tight in EM and in credit markets in general.
One of the things that we have seen recently in terms of the corporate bond market in the U.S., companies, many hyperscalers involved with the AI theme have come to the market in search of new issuance. Is that something that's playing out in EM at all as it relates to AI?
Very little. I mean, I believe there's only been one issuer out of China that was a direct data center issuer. And then you get the Alibabas and Tencent and who are sort of more in the AI space, but it's not really much activity going on in terms of the hyperscalers and data centers. I mean, it was interesting. There was a headline, I think, back in October that said that OpenAI, which has been funding everything that it can get its hands on, it seems, and I'm not sure where the cash is going to come from, but was going to do a $25 billion investment in a data center in Argentina. So I'll believe it when I see it. So I don't think we're going to get much of that going on in EM, and I don't think we need to. Most of these data centers are going to be in developed markets in the U.S. and in China, and And so I don't anticipate much action from that perspective, even in 26 for EM.
So just to focus on duration for a moment, where are you finding the best opportunity if you look across the curve?
Yeah, we used to be in front end, but given how flat the curves are, we've sort of looked at the belly of the curve, so 5 and 10-year parts of most curves. I mean, curves have really flattened in quite a bit. There's only about a 10 or 20 basis point pickup if you go from 10-year to 30-year in most EM curves. Now, that's more investment grade, triple B, some double B, at least on the sovereign side. So we favor 5 to 10-year parts of the curve. After that, when you get down to lower rated credit, you have to be on a case by case basis. So there's not many in the single B range that we're very bullish on today. I mean, Ecuador we think looks interesting. We still think Ecuador continue to have fundamental improvements. Argentina was an interesting one for the last 3 months, but it's fine at 10%, but I don't think you're going to get any kind of tightening. So as long as you're willing to take carry in Argentina, which sometimes can be a little daunting. But otherwise, when it comes to other curves, we prefer not being in the 30-year and being more in the 10-year.
So within EM, as you look out to the year ahead, I'd like your take very quickly on the macro and the extent to which you may see some sort of pickup in default risk. Is that something you're concerned about?
No, not at least not from a sovereign perspective. It's pretty interesting. We actually have had no defaults last year and this year in sovereigns, right? So we had some restructurings that came out of the whole Russia-Ukraine crisis that saw a number of credits needing to reprofile. You may get one. Senegal is definitely on the radar for restructuring. They're saying they're committed. The IMF is a little bit of a differential, so you might get that one, but it's not a huge market exposure. On the corporate side, you had some pickups in a couple of very isolated cases, predominantly in Brazil. But overall, the backdrop remains reasonably positive. I mean, it's a little boring just to say that, we're going to get 3.5% to 4% growth, but that's probably what we're going to get. I think the biggest risk to watch that could lead to higher defaults is if you'd get some sort of a sudden stop in all this AI and other types of funding, or just some sort of a pullback in activity. That would be a concern for me. But otherwise, the backdrop is reasonably constructive. I mean, we're going to have growth that's picking up in the U.S. We have, frankly, you saw that in the Fed's projections. They raised their growth outlook for 2026. Part of that's the delayed government shutdown. But most economies should be picking up in developed markets. That translates well to EM. So we don't really have a major concern for defaults other than just idiosyncratics where you have to do your homework.
Okay, Jeff, we'll leave it there. Thanks so much. Jeff Grills is head of U.S. cross markets and emerging markets debt at Aegon Asset Management, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Equity markets in the APAC region are rising in sympathy with U.S. stocks. That's after the Fed cut its policy rate, as expected. And Fed Chair Jay Powell seemed to voice a bit of optimism about stronger growth, while at the same time suggesting the inflationary impacts from tariffs will fade away. That's where we begin our conversation with Christina Woon, portfolio manager at Eastspring Investments. She spoke with Bloomberg TV host Annabelle Droulers and David Ingles.
We can start with the Fed and your reaction to the decision.
Yeah, I think the Fed cut rates as expected, and that was a fairly consensus view as well. I would say that what that reiterates for me is that we will see into 2026 traditional opportunities or avenues for income tail off a little. And then when we think about how the market's actually done so well this year as well, perhaps a narrowing of the opportunity set for alpha as well. So I do think that going into next year, where we are right now, we probably will have to be even more selective in trying to drive both income as alpha for equity investors.
Okay, well, I was going to ask you then what this means for a trade that's been very, very popular, Christina. David here, by the way, we talked at length about this already with you too. The AI trade and the mega cap play in the U.S. And we've seen an internal rotation within some of those big names in the U.S. of late. How has that affected how you look at your portfolio, or has it affected you at all?
Yeah, definitely. I mean, I would say that just given how everything has shaped up over the year, or actually over the past few months within the AI trade, that strong rally means that it is definitely a key risk that we have to watch, even out here in Asia. You know, we've got diversified supply chains here, but it doesn't mean that it's something that we should be complacent about. So I do think it's something that, I've been taking a bit of profit into the rally. But having said that, I do remain constructive on the trade. You know, I was in Seoul just last week speaking to some of the big memory makers, and the consistent message that we've been getting is that supply into next year remains very tight. So that does have positive support for demand and supply within certain spaces. So I can find some comfort by focusing on where the bottlenecks are within this trade.
And so how do those continue to perform? I think obviously the big theme we're watching is Oracle, for instance, and in their latest numbers we see quite a significant capex spend, a lot more than Wall Street had been expecting, but still that ROI isn't there quite yet either, or at the level that's been anticipated. How long is this sort of going to also sustain? Of course, they've got the demand for memory from the likes of Samsung or SK Hynix, but when does that also start to reach a tipping point, do you think?
Yeah, I think the worry that we have when we see all these big capex numbers, and I think we've seen that expressed in the market as well, is on the funding side. But again, if we look at cash flows, and if we do see, or we do have the expectation that cash flows should pick up a little alongside or keep pace versus where they are right now, then there should be some support for that overall rhetoric. I would say, though, going back to my point earlier, that's where we really do have to focus on where the bottlenecks are, because that's where that gives you more visibility and comfort in playing this trade. The worry, of course, that people have in mind is with all of these big numbers that we're seeing, is there the risk of double booking anywhere? I think we have to be cognizant of the fact that risk will always be there. So again, to solve that, you have to focus on where the bottlenecks are.
And risking asking you the obvious, where are those bottlenecks? And you just mentioned that you've recently come from a trip to Korea. Is it in that market? Because that market's also done exceptionally well, and I wonder how you pair that with the price right now.
No, I think that's absolutely right. So Korea's been such a strong market this year and it's driven so much by tech. I would say, though, that the memory players, just given what I've heard from them about the complete lack of clean room facilities into next year, and capacity doesn't just come in overnight. You can't snap your fingers and magic up capacity. So we're still looking at that situation remaining tight at least into next year as well. So I do think that within the tech trade, the memory players do stand out quite well. The difficulty with that, though, is just given how we balance that out with where sentiment is, which is why I do think that for prudence sake, taking some profit into the rally still remains my stance at this point. And then elsewhere in Korea, I wouldn't forget that there are the themes that are playing there as well. I'm still finding ideas. So, for example, just last week or earlier this week, we saw the dividend tax reform come around as well. So that does have implications for how companies will be thinking about their shareholder return policies in the coming months. So that could be a potential opportunity for income funds too.
We've spoken with a few analysts that are saying that in light of these concerns around the AI bubble, essentially, they're thinking maybe India could present a good diversification opportunity for 2026. Are you in that camp as well?
I am. I mean, I would be in agreement with that. And, India has quite a number of things going for them at this point. Domestically, they had their RBI cut last week. Inflation does remain benign at this point, which does benefit household spending. Going into next year, if we do see a finalization of any trade deal with the US, that could also be positive for sentiment. So a number of things that are lining up possibly into next year. And then, as you mentioned as well, just given how many of the companies or listed companies in India aren't as driven by the AI trade as you would see in the rest of the world, it does present as a pretty good AI hedge in the current times from a portfolio perspective. So I do think for diversification reasons, India is actually a good allocation to have at this time.
That was Christina Woon from Eastspring Investments speaking to Bloomberg TV host Annabelle Droulers and David Ingles here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.